Guys, we have a brand new tax bill to discuss that changes a lot of the way you see taxes and a lot of the ways that you are going to do things as a business owner. So let's get into it. Boy, President Trump has passed a new tax bill that is coined the Big Beautiful Tax Bill. As of recording this, it is currently passed through the House and it is still looking for approval from the Senate. But for all intents and purposes, it feels like this bill is going to be pretty much it. So let's discuss what you as a business owner can take away, what we need to plan and strategize for to help you this year in 2025 amongst all the changes. I have taken a look at the bill. It is a whopping 1,100 pages. I have some of it printed. I did not print the whole thing. We love trees around here, but I did print out some of the biggest provisions that I wanted to look at a little more closely. And man, I got my notes. So we are going to jump in and discuss. First off, welcome to the channel. I am Alan Pruitt, a CPA and a tax strategist that specializes with entrepreneurs and mental health professionals to make sure that you are optimizing your business, you're optimizing your taxes, because guess what? It is always easier to save money than it is to make more money. So let's save some money in taxes because, hey, we love tipping waitresses, but we never want to tip the IRS. So let's go and jump into the 7 tips that you need to know as a business owner with the Big Beautiful Tax Bill passed by President Trump. All right. So first thing up that we're going to discuss is bonus depreciation. What does that mean? Bonus depreciation is back to 100%. This was actually in effect just a couple of years ago, but the current bill phased it out. It went from 100% to 80% to 60%. They have now gone back a couple years to 100% bonus depreciation. What does that mean? That means if you buy a vehicle or a big equipment, if you might have some technology type things that you buy, but just think of big expenses in your business. Typically, you have to depreciate those items, which means, let's just say I buy a vehicle for $100,000. Well, I can't take that full 100,000 in the first year because that vehicle is going to last 5 years. So we break that up, 20,000 each year. Aha, but bonus depreciation, that means we could take that full amount and deduct that in the first year that it is active within your business. Phenomenal news. So this is such a great tax deduction if you are somebody who is looking to, buy some big equipment. Buy a vehicle is one of the very, very good ones that this is applicable for. And so if you might remember a few years ago, there's a lot of talk when it was 100% on it being a 6,000 pound vehicle that you could write off under your business, that whole deal, right? That was a great tax write-off. And hey, I take my own tax planning advice. That's something I took advantage of back in 2022. Well, now here's what you can do. If you need to buy a vehicle, trust, we're not going to be out here buying vehicles or big equipment if we don't need them. But if you do, then you can take that and get 100% of that purchase written off in the year in which you buy it in 2025. So now you ask, hey, let's say you buy a vehicle, but you are a small business owner. You also use that vehicle personally. So how does that affect you? Well, what that means is if you use that vehicle at least 51% or more for business, as long as it is a majority business purchase, you can depreciate that vehicle. So let's take that same example, $100,000 vehicle. Let's say you use it 51% business, then you're allowed to take depreciation on that to the tune of $51,000. So you have to take the percentage of what you're using for business, and that is still the deduction that you get. So that is huge. And here's the other beautiful thing about depreciation is that you still get to write off actual expenses for that vehicle. So now you get either depreciation or you get mileage. But when you do depreciation, then the actual expenses, just think repairs, oil changes, anything like that you have to do for that vehicle, interest, you get to write that off. Now there's a new personal interest write-off, but you as a business owner, you can write off interest that you're paying on a vehicle. So that opens up a huge deduction for business owners. All right. Tip number 2, QBI, qualified business income deduction. What is that? What does that mean? So this was something that was passed back in the initial Tax Cut and Jobs Act that the Trump administration passed back in 2017. So what that does is that gives you 20% off as a business owner of your profits before you have to pay tax. So let's say you are somebody who made $150,000, you have $50,000 in expenses, that leaves you $100,000 profit, right? Well, the QBI says we can take 20% off of that, say $20,000 before you pay taxes. So you only pay taxes on that $80,000 that's left. Are you tracking? Now, what that number has gone up to, that has gone up to $23,000. Sorry, 23%, which in this scenario would be $23,000. So you get an extra 3% deduction as a business owner just for simply having a business. So that is a increase up from 20%. So great deduction there that you want to make sure that you are taking advantage of as a business owner. All right, what's up next? R&D expenses. So research and development is what this means. And a lot of people think you have to be, maybe some, big AI outfit or some manufacturing company, some kind of tech company to take advantage of R&D credits. There are a lot of businesses out here that aren't in those typical things those typical industries like that can still take research and development credits. Let us know if you have questions about that. We're more than happy to walk you through that process. But they've made some changes to R&D to where you can essentially expense most of that in the first year, because typically they make you kind of spread it over 5 years. So a few different nuances in that, but that is a big one. If you think that you are somebody who is improving a product, improving a process, something like that, that can be qualified as R&D, that is a very good one as well. So number 4, this will hit just about every single business owner. You have probably heard of 1099Ks. There's a lot of talk about 1099Ks just a year or so ago, because there was talk on bringing that number to $600, meaning if you had any third payment processors that you use, think PayPal, think Stripe. For my mental health professionals, your EHR, if you're processing claims through your EHR, then you would get a 1099K. That number has typically been $20,000 or 200 transactions before you have to get a 1099K tax document. Well, they were talking about bringing that number all the way down to 600. Well, this new bill makes sure that that number stays at $20,000. So if you are doing payment processing through, through Stripe, through PayPal, through different platforms like that, then you will not get a 1099K from them unless it is over $20,000. So much more ease on the reporting requirements. Here's another big one that's going to hit literally just about every small business owner, and that is 1099 NECs for contractors. So if you hire a contractor in your business, then you have to have them, fill out what's called a W-9. Pro tax tip here: make your CPA very happy by making sure that you send out W-9s to anybody who's going to be a contractor for you. Side note on that. But what we want to do is make sure that you are covered. And so anybody who fills out that W-9 who you think you might have to pay more than $600 to previously, we have to send them a 1099 NEC that is due by January 31st of every year. That number has been $600. Well, guess what? They have now increased that to $2,000. So that is a very big increase from $600 to $2,000. So that eases a lot of compliance requirements now. Still have them fill out their W-9. But if you have somebody who you pay less than $2,000 to, you are not required to send them a 1099 in January. So that should help a lot of small business owners. So next up, tip number 5, opportunity zones. Are you an investor? If you're an investor and you don't know what opportunity zones are, you need to find out, because opportunity zones are a great way to make sure that you're optimizing your investments. What's an opportunity zone, you ask? Glad you asked that. What that means is the government and the states get together and look at certain areas. Obviously, not your, big fancy budding areas, but areas that they want more investment in. So then what they do is if you invest in a rental property in that opportunity zone, then you get a better deduction. You get certain write-offs. So there's a lot of different rules in that. We can have a whole video just on opportunity zones. But if you're an investor, I want you to be aware of looking at opportunity zones now. So the biggest thing that's happening with opportunity zones is that you can do a gain deferral, which means if you are making capital gains on that, you get to defer a lot of those gains. And just remember this, the golden ticket for almost any opportunity zone, check this out. You invest in a property, you hold that property for 10 years, and it's in an opportunity zone. All of that gain is tax-free money. That is the golden ticket for opportunity zones. So if you're an investor, be looking out for opportunity zones and let us know if you want to discuss that. All right. So number 6, boy, there is a big one for commercial buildings. So as you guys, has anybody heard of the word tariff? Anybody heard of tariffs lately, right? So as you can imagine, this administration is big on tariffs. And so the other thing that they are doing is with that, as you might very well know, they're trying to prioritize manufacturing in the United States and not as much outsourcing as we have been doing. Well, what does that mean in commercial building space? They are now giving you essentially 100% bonus depreciation on commercial buildings if you are doing manufacturing in that building for the US, in the US naturally, right? So that can be huge because a building is typically depreciated over 39 years. So whatever that purchase price is, just think, you have to spread that amount over 39 years for simple math. Let's say it's a $390,000 building. Well, you would have to take that over 39 years, which would give you what? $10,000 deduction each year. But now if you do some type of manufacturing in that building, now you could take that whole 390 in this situation and write off that entire 390 in year 1. So that is a huge one. So my investors as well, this means that you probably want to look at investments that are having some type of manufacturing done, because that is a huge deduction that can save you a boatload of cash. All right, so what's next? Number 7. So number 7, we're going to look ahead just a little bit. So what does that mean? So typically meals for business owners have been 50%. Outside of our COVID years where people were trying to, where the government was trying to get people back into restaurants, they gave us 100% meals in. I hope you took advantage of that then. I know I did. But what's happened is that has typically been 50%. But then also what they have limited is, let's just say, hey, you're going to have a meeting. You tell everybody come into the office, or let's say you're working late. Well, unfortunately, those meals have been 50% as well. Well, not anymore. They are actually potentially changing that. The reason why I say potential is because that deduction was through the current Tax Cut and Jobs Act, which goes through 2025. In this current bill, there is not any mention of them renewing that, which means that those meals could very well be back to 100% in 2026. So we want to make sure that we're looking at that and, looking at tax planning, make sure we're taking advantage of meals. So that's the first piece of looking ahead. And then keep this in mind. If you have any type of employee event, that event is going to be 100% deduction, even if you have food at that event. So that, backyard barbecue that you're having for your staff, or, you rent out, a facility for them where you're doing mostly business, but even it's about connecting the team, is good team building. Those type of activities are still 100%. And so then next up, what we've got is, the other thing here. All right, so the next thing that we want to look ahead to, and this is going to be a really good one, is there is also no mention in this bill of entertainment. Why is this important? Because entertainment expenses, when the Tax Cut and Jobs Act was passed, was actually cut out. So that means that entertainment for business purposes, let's say, hey, you're trying to close a deal and you want to take a potential client out to the golf course, or hey, you got some tickets to, a baseball game, basketball game. Hey, I'm in Houston, in Texas. The rodeo is big, right? Let's say you want to take a client out to the rodeo. Well, that's still considered entertainment, although it has its business purposes on potentially getting you, closing that deal, building that connection with that client. That's still considered entertainment by the IRS. And that was completely cut out in the Tax Cut and Jobs Act. Once again, in this bill, there is no mention of them reinstating that or continuing on with that limit of no entertainment expenses. So that's another thing in 2026, we might be able to write off entertainment expenses. So that client that you want to close, take them out, that can be an entertainment expense now. So potentially, we'll see what happens, but so far it has not been mentioned in this bill. So, alrighty guys, that will do it. Be sure to like, subscribe, and comment. We appreciate you so much. Comment below. Let us know if you have any other questions on this bill that you think can help you as a business owner. But here are your top 7 tips that you need to know about the big, beautiful tax bill that will help you save money in taxes this year. Alrighty, y'all. Peace.